Hi, welcome to One Finance, and in this video we're going to cover the performance of Mabuhay Fund for the year 2022, and here's our short disclaimer. And our discussion points. We have a few market updates. We have also the portfolio performance review. Let me just get my laser pointer here. Okay, so for the market update, we have the US interest rate versus inflation I have here. So if you're going to look at inflation in the US actually peaked sometime in July, that's around 9% at least. And then it ended around 7% in December. So that easing of inflation figure is actually a relief for the investor, for the market. And if you're going to look at here, the interest rate trajectory of the US is now above 4%. That's around 4.5%. Now, we may see this interest rate move to 5% or stay for at this level in 2023 if we can't see this figure inflation rate drop to the ideal value which the Fed targets, which is around near 2%. Okay, so we all know the impact of high interest rate. It would increase the discount factor for the valuation of assets. So higher discount factor would lead to the decrease in their valuation. So we can leverage by at least holding some short duration bonds because that would benefit from the interest rate trajectory, and as much as possible defer or be defensive in holding growth stocks or in particular tech stocks. Now for the Eurozone, we have here the currency. We have the euro actually went to parity versus dollar sometime in July. If you're going to look at it, it actually touched 1:1 ratio, but then it was able to recover sometime in November. Okay, and um, actually the ECB just hiked another 50 basis points of their policy rate. Thus, if you're going to look at it, actually recovered sometime in December here. So versus their inflation is actually around 2.5. So that's pretty high in their historical value. So we may see the interest rate move a bit higher than the 2.5 value. That would perhaps give more strength to their currency versus the US dollar moving forward in 2023. So for China, if you're going to look at here, we have their manufacturing and services PMI. It's still below 50, meaning in contractionary um, figure. But if you're going to look at, that's actually way below their 2018 value. If we're going to look at here, manufacturing, that's around 54. Now at sub 50 for services PMI, that's around 52 now at 45. So we have a lot of tensions in China. We have, of course, the zero COVID policy that's restricting the mobility of the business. We also have some issues in the tech sector, including the war on chips with the US. And of course, the tension in South China Sea, wherein we have China versus the claiming sovereigns in that bodies of water. So we have Philippines, Vietnam, China, Japan, Taiwan, uh, yeah, discussing around who's gonna take all the um, South China Sea. Okay, there you go. So we have to be very careful in choosing some assets in China. Although they have very stable inflation, their inflation is actually around um, 1.5 to near 2%, and their interest rate is almost flat, like 3 point at least 3%. So we have to actually the portfolio is exposed to some of the financials of China and some of the tech stocks who are or which are actually currently undervalued. Okay, so let's move to the second portion of the portfolio or the presentation, which is the portfolio review. So we have here the performance of Mabuhay Fund for at least a year. So from 2022, we started in February, and then we ended in December with negative 4.91% unrealized losses. But if you're going to look at our benchmark here, the S&P 500 index actually performed negative 18 or at least negative 19 for 1 year. So therefore, Mabuhay Fund actually outperformed the S&P 500 in a 1 year performance time frame. And then the dividend yield of the fund is actually 14.60% as of December, but the target is actually around 10%. And then some of the core assets giving us high yield, we have the SDIV ETF, which is a diversified ETF. We have the Magellan Financials in Sydney, which is more on asset management. We also have ARR in the US, which is more on managing a real estate investment trust or REITs. We have the IEP or the ICANN Enterprises, which is a diversified industrial conglomerate. And finally, we have the qualified yield covered calls for NASDAQ 100 ETF. And for our trading results, we have it for 30 days executed around. We have profitability of 70, and then realized profit of 0.75. For 3 months, that's 1.87. For 6 months, that's around 2.90. And for 1 year, that's around 2.58. So it's not just about holding assets for long term, that's investing. The portfolio is also capable of doing trades. So those are tactical trades in the short term, which would amplify the periodic yield of the fund. So it's investing and trading at the same time. For our geographic and sector exposure, we have here the largest exposure. Around 70% of the assets are allocated to the US market, of course, the largest market in cap. And then we have followed by Australia, and then the rest in Asia Pacific. For the sector exposure, we have at least 40% of the portfolio exposed to real estate. Now, this strategy is very aligned to our objective in delivering monthly income and target dividend yield of at least 10% a year. So that's why we have here most of the REITs are being part of the portfolio strategy. And then we also have some tech stocks, consumer, and then we have hedge bonds. So our bonds, again, exposure is more on the short duration bonds. We have at least 3 to 5 years in maturity, and that would help the portfolio to leverage the risk in equity space and thereby riding the momentum or trajectory of the interest rate increase of central banks across the world. For our risk management, we have here an average of 5. Target actually is 5 for the rest of the year. We have max drawdown on a daily basis, that's around 3.75. And then on yearly, that's negative 20. Allocation of assets per risk, if you're going to look at here, most of the assets are actually with low risk. That's around more than half of our holdings. By the way, we have at least 30 or 35 assets in the portfolio right now. And very low risk, around 10%, 27% medium risk. And we only have a few higher risk. Now, these assets are considered as tech or growth stocks, which are intended for short-term trading purposes only. And that's it. Thank you very much for listening. I hope that you can give this video a like, share, and then subscribe. And don't forget to follow us on eToro. Have a nice day.